Barry, if you could just sort of spell out for us like what a decline in the market and the economy normally does to the demand for commercial leasing.
Well, that's what creates a decline, usually. If there is a decline in real estate, it's directly a result of the rise in the vacancy. So most of the recessions and most of the bad turns in real estate have been a result of a variety of things, but the biggest factor is oversupply and lack of demand. Now, the good news for the market in New York has been that there really hasn't been an oversupply in spite of all of the new towers that they built. There has been a good balance between the addition of new supply and the growth of industries in New York. And if you look at the magnitude of the market in New York, the amount of supply that's put in the market has been relatively stable and consistent with the growing demand.
So, Bruce, do you think that currently we are in some kind of cycle, or what's your current prediction on what's happening?
Well, we're definitely in some kind of cycle. The question is, how long will this cycle extend? We've seen an awful lot of deregulation that has helped protract this particular cycle. And as Barry said, and I'd add a couple of things, typically when we see the cycle change, there are three leading indicators. So supply and demand get significantly out of balance. Employment is a leading indicator. When employment clearly begins to slow down or we see significant cutbacks, the cycle's about to change. There's no indication of that at the moment in terms of what's transpiring on the employment cycle. We've seen a shift between urbanization in the gateway cities from suburbanization. That trend is here to stay. The largest part of the workforce today is the millennial generation, and corporate results, for the most part at this point in time, are fairly robust. The things to watch out for in the future, in my opinion, are what happens to this economy as a result of some of the policies that are in place today. I don't want to get overly political, but we should be watching to see what happens in the trade war if it gets protracted. We should be watching to see how employment growth goes forward in perhaps an overheated economy. So I think there are more watch-outs right now, but I am a believer in cycles. It will change, and it will change abruptly at some point.
So then what do you think that'll mean for these new sort of models that have emerged, that being co-working predominantly, and on the back of that also co-living?
For Barry or I, would you like me to lead? And then I think the co-working, co-living models are tremendous, highly sustainable, and I'll give you an example. I had breakfast this morning with a major corporate user, and I said, what percentage of your current workforce is in the co-working flex space industry today? And he said, maybe 1 or 2%. And I said, and ideally, what would it be? And he said, probably as much as 10%. So if you look at what the potential is and where the co-working or flex-based market is today, there's room to grow, number one. Number two, I would point to gap law change. Gap law change has now required the corporates put their lease on balance sheet day one versus amortizing it over time. That, in my opinion, favors the co-working flex space community because it allows you to move a portion of your space off balance sheet for whatever term you want. And let's be clear, co-working and flex space has disrupted the industry in a positive way in the sense that corporates have longed for flexibility for a long time, and the number of locations available to them to do this in and the ability to move some real estate off balance sheet, have that kind of flex component to their total portfolio for the large user is a plus in my opinion. I'm going to leave it there and let my friend and colleague Barry pick up.
I think the big misconception with co-working is, the typical layman will look at it and say, I lease the space for $1 and I go to co-work, I got to pay $2. The fact is it's really less expensive to use co-working for most companies because of the flexibility it provides them. So under the new FASB rules, every company needs to net present value the total cost of their leases on their balance sheet. So that has two issues. One, for a company that wants to remain capital light, it's an expensive proposition to have to put that on. They might as well own the properties. That's number one. Number two is the same thing with capital. If you go to a co-working space and they curate the space, imagine the amount of time, effort, energy, architects, design, all of the time and energy it takes to build a space for companies. So, the corporate real estate officers can take some segment of their space and not have to think about it, not have to deal with it. The Gen Z and the millennials like the space the way flex space is designed. So for them, it creates an ecosystem, an environment, it's curated, and they're happy to go into it. I think the difference between co-working and flex space is that many of these companies, when they spin out a new software group or some division, and they need variability on their growth, and they want to manage their growth, being in an environment where they're just one of a sea of 2-3 desk small startups versus a more enterprise-focused company where the average size is bigger. They can more have a white label, they can maintain their brand, they could keep their identity, and those people that they put are not put into a sea of a co-working environment, but into a smaller environment where they maintain their identity. Right now, 3% of the market is occupied by co-working. 3 years ago was 1%. Last year, 10% of the leasing in New York was done by co-working tenants. The industry states that they believe by 25 they'll have a 30% market share. I think that's pretty overzealous.
What do you think, Jamie?
I think this is the best panel I've ever been on. By far, I love these guys. I don't know. I think it'll be between 10 and 30%.
But there is like this argument that
Listen, I just want to say, cash, no checks.
But there is often this argument.
But the finish of my point was when I said that it really costs less. If a company wants to move, if they take a 2-year lease, it doesn't really become a balance sheet issue. There's no capital amortization. If you go take a traditional long-term lease, you spend $200 a square foot, maybe $250 all in. You amortize that over 10 years. That's $25 a year. You have no amortization of the cost on a year lease or a 2-year lease or a 3-year lease. So it almost makes sense for some element of your space for a variety of reasons, not the least of which it's deceptively not as much as expensive as you think. And the variability and the flexibility of not knowing how fast you're going to grow or how this business is going to work out. Is this new division, does it make sense? If you're a company that grows by acquisitions, as I have, we've bought over 50 companies in the last 5 years. When I go into a market, as I use co-working because I have no idea how much space I'm going to be in 18 months. In Mexico, I bought a company. We had
just back on that. Like, isn't that
8 people? We went to 170 people in 15 months.
Isn't this sort of the argument that's being made by a lot of the co-working firms is that if a decline did happen, it might actually drive up demand for your product? Is that something that you would agree with?
I have a very pithy short answer, or probably a more interesting medium length answer to that.
Right.
I mean, the short answer would be, my suspicion is a recession would be painful for us, just like it will be for 95% of industries. And if my job is to build trust with this audience, and if I said, hey, we're going to kick ass in a recession, that would be probably a tough starting point for that. However, I do think there's probably more to the story. It would take 30 seconds. Okay. Our industry, I just want to frame what it is. From my point of view, this is an outsourcing industry. You are going to customers and you're saying something that for the last 50 years you've done yourself, meaning delivering your employees' workplace experience, is now something that you should hand off to us. And the nature of the vast majority of outsourcing industries is that they kind of sputter along for a very long time as 0.5% of the market or 1% of the market. And then in most outsourcing industries, there's a moment where you see this happen. I think we're in the middle of this. And what this is usually when providers shift from saying, we can do something more flexibly than you can, we can do something more conveniently than you can, to saying, we can do this better than you can, meaning we can deliver a better day at work for your employees than you can yourself. And I think if you look at other outsourcing industries, take manufacturing, for a very long time, it was contract manufacturing, my factory lines are overloaded, and I need, 4 hours of generic factory time. And then eventually it moved to end-to-end supply chain outsourcing. And when a recession hits, part of it depends on where we are in that trajectory. If we are a low-value commodity industry that simply provides flex space, we're probably going to get in a lot of trouble in a recession. But if we are now far enough along the journey that we're closer to, in the manufacturing analog, end-to-end supply chain outsourcing, the recession is when a lot of companies shuttered their non-performing factories and moved more aggressively into outsourcing their manufacturing to high-value providers. I think it's unclear exactly where we are, and it'll depend a little bit on that. But there is a very real possibility, and we hear it from a lot of customers, that the next recession will be when they start to really double down on their consumption of outsourcing their workplace needs. I hate to predict that will happen.
So Brad, also your markets are typically residential, so you're kind of an outlier in a way, but it's like the same sort of model. We haven't seen it scale in the same way. I would want to know from you where you think we are with co-living, which I don't know if you want to disagree or not, if you think that it may be a lot younger than what we know co-working to be, and maybe where you are right now.
Yeah, of course, and maybe to talk about some of the trends behind co-living, because some of the trends are similar to co-working. For instance, the desire for flexibility, a lot of people coming in looking for community, which was more common in the early days of co-working than it is today. But it's definitely the case in co-living. But there's also some broader kind of multi-decade trends that co-living is playing into. For instance, people getting married later. The average age of first marriage from 1960 to today has gone from 23 to 30. And what that's done is created a giant population of primarily young single people that are competing against a fairly small and not increasing that quickly pool of residential rental housing stock, particularly the smaller units. The end result of that is a lot of people end up living with roommates. And the challenge with that is, one, there's no housing that is built for that use. 23% of all households in New York are unrelated people sharing a unit together, roommates. On top of that, 33%, a full third of all households, are a single person living alone. So a majority of all households in New York are either roommates or a single person living alone. Now, if you look at across other kind of top 15 metro areas in the US, there are similar trends, there are similar percentages. So what we started to do, and you could look at co-living as both a much more nascent industry, but also a much older one, in that people have been living with roommates for a very, very long time. What co-living is doing is acknowledging that, saying that, yeah, people do live with roommates. You go out to a place like Williamsburg or downtown Brooklyn, and not just a majority, north of 75% of the 2 and 3 bedroom units are roommates living together, not families, roommates. We're acknowledging that and saying, how do we design for that use? And then how do we thoughtfully operate that in a way that makes the experience of living with roommates much less risky, much less painful, but keeping the affordability and the social environment the main reasons why someone chooses to do that in the first place.
But hasn't co-living, like, we know that there's an enormous amount of investment that has gone into co-working, across the board, whereas co-living, we haven't seen the same amount of activity. I mean, there was obviously in January a German firm, Quarters. They raised $1.3 billion, which is no small number. But do you think that co-living has the ability to scale as co-working has? I saw the other example I just want to quickly provide is with Oli. I understand that it was like a 4-year turnaround before they started putting people into their building. So I wonder if that hampers or improves the business that you're sort of overseeing.
Yeah, this is a long roll business. I mean, I envy Jamie and his 4-month turnaround from taking over a space to having it live. Our average turnaround time, it's not 4 years, it's about 2 years between identifying a site and actually occupying it. But that's a lengthy period of time. Common started in 2015, so we're opening deals today that we signed in 2016, 2017, right. So in the very early days. So we have, if you look at the total pipeline and what's under development, you have 10 times the number of beds that we currently have open and billions of dollars of assets under development today. So it's a little bit more of an iceberg industry in that respect, in that you don't necessarily see the depth of it and what's coming from looking at the size of the industry.
So would you say that co-living is too young yet to see that?
It is. It's 5 to 10 years behind co-working.
Right. Barry, as Newmark, you're an investor in Notel. I think that spells out pretty interesting confidence from traditional real estate firms in I'm going to call them new age. I wanted to understand, though, you said that you'd looked at a number of different models. Was there one that drew you to Notel, or did they come to you and you had a look at them and said, it looks great and let's go ahead and deal, or?
It's because I didn't meet Jamie. Most of life is an accident. So we're an investor. We invest in things that are alongside the whole real estate continuum. We invest heavily in technology, and we've bought a bunch of companies that are some of which we think we can monetize on the outside, and much of which makes it easier for our brokers to conduct their business. So we're very focused on that. The company does really well, and we look at ourselves as a information and technology business that happens to be in the real estate space. We have thousands of brokers that work for us, and each and every day we provide information to our clients, and that information is valuable and needs to be aggregated in a way that could be articulated back to our clients to be useful and enable the brokers to be better at what they do. So that is our business. So, Notel, or we like the co-working space. I was in the co-working space as a partner with HQ going back 20 years ago. In fact, we owned the building 55 Wall, and I brought in HQ as my tenant. We were 50-50 partners. I did probably the first management deal this was in '86 when I did that deal with them. So so we've been in and around we were partners with another owner on another co-working space going back 15 years ago. So the one thing that I recognized was that there is a structural change in the way companies view their growth and their occupancy that really made a significant leap towards having an environment curated and a requirement to have more variable occupancy. So it just for the moment, it was a moment in time, a meeting, and I decided that I liked the guys that ran it. I thought they were really smart. I liked the idea of it. I didn't really like the pure co-working. It didn't fit into what we do. We are an enterprise-based business. We represent many large corporations. We were seeing a need, as a company owner and someone who has grown in markets very rapidly. I'm a client. I saw the need for it for my own growth, to manage my own real estate costs. And if you buy a bunch of companies in a market and you then have to integrate it, it's enormously capital intensive, very inefficient, and very expensive. So it provides a lot of solutions, some of which is convenience, some of which is financial, some of which is satisfying the millennials in a curated environment.
Are there any models you think don't work, or perhaps could do it with some improvement?
Say that again?
Are there any models that you think don't work? Or obviously there's different strains.
So the issue with co-working and flex working, it's a very capital intensive business. And we've invested in a lot of different kinds of businesses, so it constantly needs fuel to grow. So it's not like a purely scalable, sustainable tech investment, which you build an app, you change it, you get adoption, it grows and matures as a device, and the multiples are not impacted by the dilution of the capital. So is it a tech business? Is it a real estate business? I think it has tech elements to it, but it is a real estate business. There is an arbitrage. Now, it's a better way to curate space. People who are devoted to the ecosystem and the environment, to the Gen Z and the millennials, but it's an arbitrage on real estate and a better way to manage it and provide flexibility. It's good for owners. Now, some of the co-working and flex working that are going into the real estate business, they have to decide who's the master and who they represent and what their business is. I think that's prompted some owners to go into the business themselves by competing with their clients and competing against their tenants. So what happens, the one question I have is, if someone owns a lot of real estate and then they look at, I'm controlling all these enterprises within the system that I run, am I now in an owner's building, and I'm going to really gear those tenants to the buildings that I own? So there are some concerns I have in some of the direction of the business, and I think people have to be careful as to where they go and how they do it.
Well, I guess, from your point of view, why would you see that a lot of co-working firms tend to be, now more increasingly being valued as if they are like these tech unicorns? I mean, there's sort of a distinction there that often isn't made, and I guess you're the one steering the ship, so.
This is a tough one. I mean, I don't know how we should be valued. It's my job to posit, that we should be valued on the sort of higher end of the spectrum. I do think, we've grown at 125, basically 2 to 3x every year over year, 5 years in a row. And I think a lot of valuation is driven by growth. And when you look at a company that has 127% revenue CAGR over a 5-year period, that's deploying capital at a 50% IRR, that has margins that are very, very healthy, at some point I think it's, an investor looks, they say this is a healthy business with a lot of tailwinds. We're at the very beginning of an enormous secular shift. And if I believe that I met this team of people, like you did with Notel, or like some of our investors did with us, and said, I think these people are going to be around 20 years from now, when all the dust settles, and they are going to be one of 3 or 4 global platforms that dominate this space, of course that should be, I think, at a rather rich multiple, because you're paying so much for the future growth of the business, not paying on a current income stream, which is a very different kind of investing. And it works for some, and for others, they would say, I used to work at a value investing hedge fund, and I think the head of our fund would have said, that is so not for me. I want to pay, 6 times EBITDA and get a business that's growing 6% a year.
I think that we should look at the co-working flex space as currently in version 1.0. I couldn't answer the question about valuation either at this point, but I will say this. Version 2.0 of the co-working flex space industry is going to include more competition. As good as it is today, there will be more people that enter the fray. Barry alluded to the fact that there are owners who have decided that they're going to offer some variation of this, not competing in my view, but so that they can retain their most significant tenants. They're going to put an offering out there, but ultimately that will turn into some form of competition.
How come Cushman hasn't done it yet?
But well, look, Cushman has a different view. We want to take a look at the entire spectrum of providers that are out there. We consider it, as Barry talked about, as another arrow in the quiver to offer our clients, another service product that we want to offer. And we'll advise our clients as to what the different players have and how it aligns with that particular corporate's mission.
So why would like CBRE, JLL, Tishman, like they've all gone out and made their own?
Yeah, well, Cushman Wakefield has taken a different position. Rather than invest in or build our own, we're going to advise our clients, and in certain cases, no doubt, we may white label for our larger, if you will, portfolioed clients, where we may co-brand with the appropriate provider, but we're going to advise them. Because as I said before, co-working and flex space right now are offering different types of products, and they're more suitable to different types of tenants based on the need. If flexibility is ultimately the use and you're an enterprise user, there are several players out there that you can offer, and more to come. We want to be in a position to offer the full spectrum of what's out in the marketplace today. But be clear. When I began the conversation earlier, I said that the one provider that I talked to said, if it's 1% or 2% of my portfolio today, it's going to be 8 or 10% in the not too distant future. Barry talked about some of the reasons why, including balance sheet economics, capital use. All those things are truisms. And regardless of whether we enter a down economy at some point or we see some adjustment in the cyclical nature of the business, this space, co-working and flex, is going to grow because it's what corporates have wanted for a long time and not been able to avail themselves of. So there's room to grow.
I see a lot of evidence of that, by the way, in a transformation in the way that brokers have behaved in the last year, and it's been so good for clients. It's been really helpful for us. So I think, your people are walking the walk, not just sort of talking the talk on that.
Well, I think also that there's a recent case study that we can unpack. Rudin just said that they were going to sell 110 Wall Street, and they've got 100% occupancy by WeWork in that. I guess, Barry, I'd be curious from you to know if you think that having WeWork as a 100% occupying tenant, would that affect the sale positively or negatively? Or do you think it'll just provide an interesting case study into what may happen?
I'm not a big fan of a co-working space taking more than 15-20% of a building. I think then you've diminished the credit quality of the building. Some of the owners, if the market ever gets to a point where the banks will look at owners who do their own co-working and have month-to-month tenants, 2 months tenant, like a residential, like the residential business, maybe that'll happen over time. I'm not sure, but I think that anybody that takes any co-working company for the whole building has to assume that their ability to finance will be severely diminished. So I'm not a big fan of it. The idea of owners getting into it. It's like anything else. You could be in any business. You want to be all things to all people. Good luck. If you decide to be in the co-working space, that's You better have a large portfolio, and you better have a devoted management staff, because it's management intensive. Either you're in the co-working, flex workspace business, and you spend every waking minute trying to figure out how to make the experience better, or not. What they should do, in my view, is they should do a managed deal with a professional that does it, and get a scrape above a hurdle, charge a management fee, get a hurdle, pick one of the co-working or flex work people that you like, make them your partner, and go 50-50 above a hurdle rate.
Yeah.
And that's a better than doing it yourself. Sure, are the interests completely aligned? Not if they own they have their own facilities and not, and you just have to be careful in that regard. But I think, we've done a bunch of management deals, and I've promoted management deals. I think as the business matures, owners will be more readily interested in that kind of structure.
Yeah, the one difference between co-working and co-living is that the residential side has been, fortunately, forced into that model really from day one. Because in co-working, it's very typical for a business to go master lease a floor. In residential, that's unheard of outside of corporate rentals where they can pay a premium. So common and most co-living operators have been doing management agreements really from day one, which has the positive of making the buildings a lot more financeable. You have creditworthy people on 12-month leases. It has the challenge of meaning that we really have to convince the owners, the developers, the capital, which often means bringing capital into the transaction to get co-living built. That started to change in a very big way over the last 12 months as more capital has come into the space and it's gained more credibility.
Well, residential, the rents are so high, and people, we're running out of people who could afford those rents. You need to come up with a solution to that. We were an investor in Sonder, and we've looked at Lyric, and those people. We've done a lot of deals for those companies as a base of an apartment building, rental building. So I think that in that part of the space, it makes a lot of sense to me.
Bruce, there's another case study I did want to unpack, and I thought it was an interesting one that popped up last week. RXR announced that WeWork was going to be moving into 75 Rockefeller. That means that WeWork will be in the same building as Airbnb, who will be opening some kind of hotel stay, and also Convene. I'd be curious to know why RXR or a landlord would choose to so heavily stack the building with all these new sort of hotel co-working models, and maybe what that represents.
I'm not going to comment specifically about 75 Rock, but I'll go to neutral territory and just say this. What landlords are beginning to understand is that the user base for their building is changing. It's why today a landlord who sees substantial vacancy understands the first thing they've got to look at is amenitization. It's not just redoing your lobby. It's not just putting in destination dispatch elevators. It's how do you activate the space so that future users want to be there. So in a building where you may see multiple players that would activate the space, I think it's speaking to a generation of worker that's going to access all of them in different ways. And it's coexisting in a new way. It's version 2.0. It's why I refrain from, at the end of the day, I don't think you can say that a large, because I won't speak to any specific player, but I think we have to be careful to distinguish between a large tenant occupying a full building, which really doesn't bring a severe discount to any exit strategy, be it finance or sale. I don't think we can distinguish that between any today coworker or flex space user who's occupying a large percentage of the building. In the long run, as 2.0 continues to emerge, I don't think there'll be any kind of difference at all.
Would you want to move into that building?
Well, yeah. We actually we have buildings where we're in the same building as WeWork or other providers. I mean, if it would be helpful, I think the point about co-working should not be 100% of a building, could not agree more. This point about the everything building coming of the future, the highly amenitized building, I would love to just say, in our sort of view, what V 2.0 will look like. Meaning, if you close your eyes, what does the office building of 2026 really going to look like? Because I think it's quite different from the building of today. And part of what's hard on these panels, or when we talk about this, is we're trying to sort of go back and forth between sort of describing some future state of what office buildings look like and the kit of parts we currently have. So what I would say is, where we're headed is, you're going to have, and this is, we don't really sign arm's length leases with landlords anymore. We do partnership agreements to transform the building. And what it looks like is, you have a portion of the building devoted to highly productized, highly shared co-working for teams of 20 and below. You have a portion of the building devoted to what you would call flex space, highly customized space for larger teams. And that total portion should be 25% of the building. And the whole purpose, the thing that's really transformative if you're RXR or Brookfield or Blackstone, is to use that 25% of the building to transform the performance of the other 75% of the building, to drive up the lease rates, to drive up the lease renewal rates. And part of the way that that works is that I think for a lot of customers, you know, they don't need 400 people worth of flexibility. So Prudential, let's say they have 500 people in Denver. Prudential might say, I don't know if I'm going to have 650 people in Denver in 2024, or I'm going to have 400 people. But there's no world in which I'm going to have 0 people in Denver. Therefore, what I really want is to sign a long-term lease for a portion of the building, a medium-term agreement for a portion of the building, a short-term rolling subscription agreement for the portion, and have a service provider like Industrious stitch together that entire experience for my employees. And in the most, you know, what it will actually look like in real life, if you're an employee, is that you'll be in the Prudential controlled portion of the building for part of your day. And that's mostly open floor plan working. You've got someone sitting to your left, someone sitting to your right. It's kind of annoying. It works if you're responding to email, but it's a nightmare if you have to sit and write, you know, a strategy document. So there's a bank of focus rooms at the building level when you really need to get away from your colleagues. There's a bank of 70 huddle rooms. There's a bank of 110, you know, phone and quiet workspaces. And people will move throughout the Ernst & Young or Prudential controlled portion of the building and the shared amenity portion of the building, hopefully in a really seamless way. And when that happens, it won't just be about amenities. It will be about a building that actually transforms what it feels like to work at that building. That's the holy grail. We're probably 5 years away from that future state, but that's a lot of what the deals that are being signed today are geared towards. And I think we would have to learn some very new, very surprising things for me to not believe that by 5 or 7 years from now, that actually will be what many of the office buildings you walk into look like.
Well, and just one other thing, because I think you've articulated very well that potential future state. Again, I think we're early days, and one thing we do know already is that the way you curate a building, even now, is vastly different than we did just several years ago. So that's a given, and how you curate a building several years from today, whether it's 2, 3, or 5, is probably going to be vastly different than what we're thinking at this podium right now. Well, the bottom line is, though, we're reflecting the workforce of the future. And at the end of the day, for corporates to retain and attract that future talent, in that war for talent, the asset that they're in makes as big a difference to that process as the company that they are. It's all melded into the decision making for Gen X and for the millennials as to where they want to be. All that is fact. That's why geography today is no longer as important as it was. It's the makeup of the building. It's the 24/7 live, work, play. we're entering a new phase that I think is irreversible and quite frankly, pretty exciting for the workspace.
I did just want to throw out just some questions before we go on. Have we got any? We've got a few. Yep.
Can we get a microphone to these?
So he was asking, I think, do you think there's a future where the occupier might sign an agreement with an operator like us? So Google might say, we're going to take a whole building, and then we're going to hire someone like Industrious to market 30% of that space that we took to outside parties. I mean, first of all, that day has come. So lots of occupiers come to us.
They're already doing it. They're doing that.
Yeah, it's happening.
Yeah. And they're saying, I want you to manage, my headquarters for us, or I want you to manage all this space we have. And some of them are saying, and you know what? I want you to take this portion of it that we're not really using, turn it into an outward-facing, revenue-generating product for us. And 6 years down the road, when we're ready to grow into it, we're going to take that back from you. That is already happening. And it's a good question because I don't think it's been reported on that much in the press. But a lot of those deals have already happened.
I think the one thing that is happening, and it's just my opinion, I think these buildings are being over-amenitized. I mean, the flex work, co-working, the concept of running a convention center or a convention conference center in a building, it's space that never gets utilized to the extent that it should. You can't monetize it. It basically... I think we're over-exaggerating that. I think that should be tamed down. I said, if the flex work companies have some level of amenitization as a service to the building as part of their management deal, that's fine. But these overzealous, amenity-rich environments are really going to, it makes it hard, it's going to be hard to make money. They just take 50,000 feet away from a building. That's a lot of space. And
That's Barry wearing the owner's hat right now.
No, it's not. I think it's kind of silly, actually. And running that business, by the way, because I own buildings where I've had that. And I remember, it's an hour-to-hour business. It's enormously hard work to operate a business that relies on, hour rentals, 2-hour rentals, conferences, and that kind of facility. I think it's a very hard business to run, and I think it's a very expensive.
I think you're right. And I think that's the big danger for our industry. Like, if all this is about amenities, amenitizing the building, we're going to put a conference, 300-person convention center in the building. I kind of agree with you, and I think a lot of us in our industry have oversold that a little, that to say that's going to transform the experience for Ernst & Young upstairs, it's probably not going to. But the people that can transform the experience for Ernst & Young upstairs, the people that actually create amenities at the building level that aren't just amenities, quote unquote, but become part of the daily life of the employees of that building, then I do think it'll make the building more sticky. I do think it'll allow people to densify their use. But, we're right at the edge of that.
So I just want to pick up on what you just said, because I think we're trying to combine sort of theories, and the risk is that we're tackling too much here between activation, amenitization, and what co-working and what flex space at the core do. At the end of the day, there are two things that are driving this business at the moment, at least in my view. Balance sheet economics, flexibility to corporates that have not been offered before that they are going to take advantage of, and we're in the early days of that process. As I said before, and at the risk of redundancy, more corporates are going to want to have a larger percentage of their portfolio as flex space. That's the drivers. Activating the building, amenitizing the building, I agree, it can be overdone. But on the flip side, when you amenitize the building and, for instance, provide conference centers or co-working, you are also giving your tenants the ability to become even more efficient in the use of their space, reducing their commitment. So it connects, but at the end of the day, let's not connect the dots that make it more efficient to what drives the core business itself, which, as I said before, that's what's moving this marketplace.
Well, just as my last question, actually, I had for Barry, and this is more of a forward-looking statement, but WeWork just this morning talked about the fact that it's launched a real estate investment fund, about $3 billion. I want to get a bit of an idea from you as to what you think that says about the co-working company's message to landlords.
It's just basically they want to get a scrape on a promote. They'll put no money into the game. That would be I would venture to say. Some private equity firm will hook up with WeWork and think that they'll find investments where they could bridge the gap on renting, and they can get a head start on a deal. And if WeWork can get financed out and they can sell at a profit, WeWork will make a management scrape and be a tenant in the building. So it's not like they're not going to be real estate owners, because they have enough issues with raising their capital to meet their demands to build their core business. And if they could hook up with somebody that'll give them a promote on the back end, which, look, the real estate business is an interesting business because most real estate developers work with other people's capital. They're just going to be just like another person in the mix who's going to look to use their tenancy as a way to get a scrape on any promote. And it's not going to be enormous, because they're going to pay a lot of money for the buildings, they're going to pay rent, and then they're going to look to get out. And private equity firms who enter the market to sell and capture the upside to the value, and they'll just share in that. So it'll be ordinary income. It'll give maybe a leg up on getting into a building that's for sale where they could occupy space. And I don't think that much of it.
Is that in your business model?
No, we do not want to do that. I think, look, our business on the supply side is where the demand was 3 years ago. 3 years ago, we went to McKinsey and Amazon and all these companies and said, trust us to deliver your employees' workplace experience, measure it, and if we do a great job, I trust you're going to come back and double down on using us. Our top 50 customers, their year-over-year spend growth with us was 170% on average, which means we won that side. On the supply side, we're now where that was 3 years ago. We are on the hook for Blackstone to manage a campus of buildings in LA, something almost like a neighborhood of buildings, and to prove to them that we can transform the performance of those buildings. If we do, when those sell, they're going to make $110 million more than they would have otherwise, and I would like for them to keep every cent of that $110 million, because next time when they want to manage, they want someone to manage a campus of buildings. Next time when they look for a partner, they're going to come to us. That's much more meaningful than trying to launch a real estate fund and try to capture every cent for ourselves.
But WeWork started out with the idea of real estate. That was their original thought. Most of the co-working and flex working spaces started out, like most businesses, in something where that accidentally fell into something else. That's the way. You could look at Amazon. They wanted to put Barnes and Noble out of the business, and they ended up being in the logistic business to serve their fulfillment. Then they built Firefox, and Firefox failed, and they found another use for their hardware in Echo. And then the chief of staff walks into Jeff Bezos' office and says, there's this cloud. We need to build cloud. And we're growing so fast, why don't we just build way more capacity than we need, so we'll rent it to our friends. And guess what? That's 70% of their business. The business, other than the fact that they have a aspirational innovation environment, and that's the DNA of the company, the whole business is basically an accident. And I think much
WeWork
of that,
or Amazon?
WeWork fell out the same way. By the way, Notel the same way. Right. Amal sat in an office. He's a tech guy. He took a floor, he started renting it to his friends, and he said, this is an interesting business. Why don't, maybe I mean, there's a lot of these guys that I know who want to rent space. Why don't I go do it in the Flatiron District? And next thing you know, he did one floor, and then he did another floor, and then he did another floor, and no tell. It was basically an accident. You know, that's the good thing about most of life is if you can act on a good idea that comes out of some activity that you're in, take advantage. And that's WeWork. And I don't know about Industrious, I don't know about Common, but you know, that's the way it works.
Do you want a closing statement here, Bruce? Or?
I'm gonna stay away from opining on any particular company, but I'm gonna pose the question: if you're in a capital-intensive business, and co-working and flex space is, then does it not make sense at some point to own the asset, control the asset long-term, versus just through a leasehold interest? And the answer, in my humble opinion, is yes. So if all those things are true, then at some point, the business as it matures, I keep saying 2.0, but maybe this is 3.0, I don't know, it's not my world on a daily basis. But at some point, it may make sense to control the asset, which allows you to depreciate your capital investment, and perhaps it makes economic sense. So we'll have to wait and see, in my view.
With that, could we get a round of applause, please, for our panelists?
Coach?